Well, thank you very much to the organizers for putting us on the program. This is some joint work with Nicolas Vincent from Montreal. So what we are looking at in this paper is we study if productivity dispersion is actually something bad or something good. So the conventional wisdom is, it has been documented empirically that there's a lot of dispersion. And when I think about dispersion here, we want to think about dispersion of marginal revenue products. So what we measure as averages, but any model, basically standard model, predicts that if there's dispersion marginal revenue products, there's something that you could improve upon. And that dispersion has to be shown to be it's pervasive, it's very cyclical over the cycle, and it's quite sizable. So there's a lot of work showing that by eliminating hypothetical distortions and bring down this dispersion of marginal revenue products, you would gain a lot. This is the view of what we label the misallocation literature view. So the idea is there's dispersion, you reallocate resources, take it from the ones with low marginal revenue products, put it to those with high marginal revenue products, you gain. Productivity dispersion goes down, and aggregate output, welfare, and so goes up. That's a classical view. And we challenge this in this paper. We say, well, maybe actually there is increased reallocation going on, but that relocation might actually lead to an increase of dispersion and aggregate output. So that means there's always a monotone relationship between reallocative activity and aggregates or welfare, but the indicator that we see in the data, productivity dispersion, is totally ambiguous. So that means there's quote unquote good dispersion potentially and bad dispersion. The question is, can we actually write a model that delivers that outcome, that you relax the friction, there's more relocation going on that leads to more dispersion? And the answer is yes, this is what we do theoretically here. And then the question is obviously, well, if this is a possibility, then we have to kind of decompose the empirically observed dispersion into the part that can be explained by this constraint efficient improvement versus the one that is reflecting possibly welfare reducing distortions. And that will be a quantitative part of our model. And then we provide some empirical support for what is going on in our model in the real world. So we do this in the context of multi-unit firms. When I think about multi-unit firms, I want you to think about either conglomerates that operate several firms or firms that operate several establishments, factories, plants, units, or maybe you could even think about products. And in the data, what we see is, so we use census data from the manufacturing surveys. We find that close to like 80% of economic activity is accounted for by these multi-unit firms. So understanding how they allocate their resources is important. We make three contributions. First of all, theoretically, we show in this multi-unit firm context that there is some friction that we relax that leads to increased relocation, but also increased dispersion of marginal revenue products. Secondly, quantitatively, when we simulate that whole economy that consists of multi-unit establishments, we find that our model mechanism can go a long way to actually explain what's going on in the data. And empirically, we show that actually there's a lot of scope for this, because in the data, what we see is that close to 2/3 of the observed dispersion actually occurs across the individual establishments within the firms. Only 1/3 of the overall dispersion is between firm dispersion. So that's important. If you work on CompuStat data, you just see the between firm part, which is actually the smaller portion, where there's a lot of stuff going on within the firm. And the naive view, the misallocation view, would say, well, there's all this dispersion within the firms. If there must be tons of distortions within the firms. Or maybe the firm is doing something for a reason. This is what we do here. I just want to briefly highlight we stand between three literatures. One, there's the misallocation and reallocation literature, and many people in this room have worked on this. That studies the relationship between dispersion and misallocation. There's also the investment literature that has studied investment models and also the financial side of that. And thirdly, there's a little bit on within-firm dynamics. So typically, within-firm dynamics are characterized by principal-agent models. There's some work recently by Xavier Giroux's and papers that considers actually one principal and many agents. So this is kind of where we fall most closely. Okay, so what we do here in the model is as follows. We consider a firm that allocates resources across its many units. And by allocating resources, I mean allocating financial funds to finance investment projects. So we want to understand how the firm is doing this, if a firm is aiming to equalize returns or not, and possibly why not. Reallocation of financial funds within the firm will be costly. So you can think of that as, I'll go explain this a little bit more in detail in a moment. The key thing is also that firms are financially constrained as a whole. So that means if there are different units within the firm, there's an internal capital market that matters now, because you're externally constrained. The marginal value for dollar within the firm is bigger than 1. And the question is, can we actually increase the dispersion of margin revenue products across the different units or plants within the firm when we relax that relocation friction that hampers the relocation of financial resources? And then quantitatively, we'll assess how much we can explain, and then empirically, we have some support too. So in the interest of time, I'm going to demonstrate the model just in pictures. So we write a model of a two-plant firm. That is basically the most simplest setup that we can think of, where we have a multi-unit firm, but it's still computationally kind of feasible. But the issue is we have non-convexities at the plant level here. So we have, with every plant, the state vector blows up exponentially. So it gets very, very, very difficult very quickly. But this two-plant model is enough to illustrate what is going on in our world. So we have two plants, plant A and plant B. The plant A is operating certain capital stock, K. There are other inputs which we assume are static, like labor, materials, and so on, so they're substituted out already. And that plant generates cash flow with this capital stock and TFP. TFP has a firm component that's common across all the plants within the firm and a plant component. And if there is investment in that plant, there's a fixed cost to be paid. There's a fixed adjustment cost that's independent of the size of the investment project. It's still scaled by capital, so that big firms are not becoming irrelevant here. And then we have some standard quadratic adjustment costs. So these are kind of the real technological frictions when you literally put in stuff in the factory, okay? So there's another plant in the firm, which is exactly the same thing. Same technology, same firm components, same cost structure, so very simple. What is the firm here? It's an extremely simple theory of the firm, where the firm's purpose is basically to organize finance and decide investment projects. Investment projects have to be financed somehow, either externally or internally. What the firm is doing is basically collecting the cash flows from these two plants and raising external funds to finance investment. Now, there are a couple of constraints here. So the investment projects in the two plants, IA, IB, they have to be financed either internally or externally. There is an external financing constraint. So you can think of that as literally debt, or there's some limits on issuing equity. Something like your negative dividends cannot fall below a certain threshold. And then there's this cost, which is kind of key, which is if you want to shift funds from one plant to the other beyond the scope what the plant could be investing or would like to invest, then this is costly. And I want you to think of this mu here as something like there's a supervision cost or some information problem within the firm. The firm manager, they have to go to the plant manager and find out how good the ZA actually was and what the cash flow is. That's costly, okay? And taking that fund away, that matters. So in principle, you can think of the mu. If mu is 0, then there's no wall within the firm, so to say. If mu is infinity, then there's a wall here, and basically the whole idea that there's a firm with different units is irrelevant, because these two plants are just acting like independent decision makers now. So it's very, very simple. These are the two polar opposites, like 0 and infinity. What we're going to do now is we're going to solve the model, and we're going to slowly relax the mu, which is basically we make this wall a little bit permeable. Oops. And at some point, you can more easily reallocate these funds. And it turns out, when you relax that mu, that actually there's some reallocation of financial funds here within the firm, this aspect, and that leads to more dispersion in returns. And the key thing why there's more dispersion in returns is the fixed cost, because the firm doesn't want to put very small marginal amounts of funds in this or that plant. They want to have lumpy investment projects here because of the fixed costs. So that means what is kind of the crux of the mechanism here, if the firm is externally constrained and has to finance everything internally, the firm prefers to collect all the cash flow that it can get and focus its firepower on one plant and then take turns next period. That's basically what a constrained firm is doing. An unconstrained firm can synchronize plans investment project. Okay, so here's the value function. I basically explained everything in words. Okay, so we now use census data to calibrate this model and see if we can, when we vary this mu, if we can explain more dispersion or less dispersion. The data come from the Census Bureau that has the annual survey of manufacturers. So we have annual data of about 40 years. The good thing is it's an establishment or plant level survey, and you know what firm it belongs to. So as a consequence, you can see a little bit the within firm investment flows. You can see the cash flows of all the establishments, and that's relatively good. You can also see other things that are not of interest so much here, so I omit them. But basically, this is kind of key. We calibrate the model. Everything's relatively standard. I want to highlight two important parameters here. So the reallocation cost, this mu, we consider basically, importantly, two polar cases, 0 and infinity. And 0 corresponds to internal capital markets are flawless, and infinity corresponds to basically there's a complete war within the firm, and the multi-unit firm is just a multi-unit firm on paper. It's really two independent decision makers doing everything. But this is kind of the key thing what we like. So our issue a little bit is so far this is a very ad hoc cost somehow. We don't have a very good handle on how to calibrate this. If you have a good idea how to pick that, we should talk. The second thing what matters is the lambda. Because if the firm is externally constrained, then the internal capital market matters. This is kind of key. If lambda is infinity, then the internal capital market does not matter, because who cares about firm internal reallocation frictions if the firm can just borrow unlimited amounts and just stick it here or there. Okay, so now's the experiment. We look at the within firm dispersion of marginal revenue products, so it's basically log y over k. If mu is 0, that means there's basically internal capital markets are perfect. If we now start to crank up mu, of course, the standard conventional wisdom says, yeah, no surprise, dispersion is going up. This is basically the classical view. More frictions lead to more dispersion, lead to lower welfare. But importantly, this is not monotone, this relationship. At some point, it comes down again. If you crank up the friction even more, then what happens is you start stifling this within firm reallocation of funds. The firms don't shift around resources anymore. What happens as a consequence, the Y over K of the plans within the firm is actually just driven by the shock processes. And depending on when we calibrate the shock process with what we see in the data, actually the dispersion of limit, when you have literally single unit firms, comes down. Importantly, comes down below the level of a perfectly internal capital market. So here's the related aggregate in investment in this economy. What we have is at the internal capital, we just normalize that to 1. You see, as you crank up frictions, you monotonically decrease aggregates. So this is kind of what is clear. The important thing is it even decreases as dispersion decreases on this branch. So in principle, the big theoretical takeaway is that the internal, relaxing this internal reallocation friction leads to this inverse U-shaped relationship between dispersion and welfare or aggregate output. Compared to the single unit firm economy, this is basically a single unit firm economy. This is the multi-unit firm economy. The multi-unit firm economy has actually more dispersion. It's 32% more dispersed. On average, like 4% more capital and a little bit over 2.5% more output. So the question is, what is going on here in this branch? When you crank up more dispersion, the friction some more, and the dispersion is coming down. The key thing is, one moment that illustrates what's going on, I'm going to explain this in a moment more carefully, is that the correlation of the investment project is negative. This is surprising because the two plans, they have a common component of productivity. So other things equal, you would expect that investment projects are also co-moving positively. but the firm doesn't synchronize. It's actually, they're negatively correlated. So what's going on here? So I'm now focusing in on that relationship, but the strength of these things here depend on the level of the external constraint, because the value of the internal capital market depends on how constrained the firm is externally. So I'm now going to vary the lambda to illustrate what the firm is doing. So we start with lambda infinity. When lambda is infinity, basically, then the inverse u is not the inverse u anymore. It's flat, because it doesn't matter what's going on within the firm if externally not constrained. So we're now varying lambda. What's going on is that the dispersion is going up. I mean, within the firm, you have this inverse u shape with the mu. So that's a different dimension now. And what is important is, you see, when the firm is not constrained, when basic internal capital markets don't matter because the firm can just raise infinite amounts outside, the two plans do come over in their investment projects, as you would expect, because they have the same shock and part of the shock process is the same. But as you crank up the lambda, this correlation becomes negative, because the firm is now not synchronizing investment projects anymore, because more and more the firm is externally constrained, so as to basically finance everything inside, but the internal funds are only enough to basically have one investment project at a time in the firm. Put differently, what's going on, what the firm starts doing, it starts out synchronizing investment. So if you look at the relative probabilities here, that probability to synchronize investment as you crank up the external constraint is going down to 0. So the firm at all costs avoids having simultaneous spikes, because they require financing from the external parts, but financing is super costly, so you don't do it. What you do instead is you rotate the spikes. So that means you have, if there are two plants in another firm, there's a firm-level productivity shock. The firm says, okay, there are two firms here, Andrea and Nicholas, and what we're doing is, Nick, turn over your cash flow this period to Andrea, and she's going to invest, although your expected marginal revenue product is the same. So Andrea has now a very big capital stock, low MPK, and next period you take turns, basically. So basically, the external constraint induces a reallocation cycle within the firm that just takes time to pan out because of the internal constraint. So this is that. I mean, when we carefully calibrate the model to the US economy, we're kind of like at this point here. So you see that these rotating spikes in two plan firms are much more likely. And also the within firm dispersion is higher with internal capital market than the economy without internal capital markets. And this extra dispersion reflects staggered investment, not pure distortions. It's actually shutting down the firm would bring down dispersion, but it would also kill a lot of beneficial relocation, or like constraint efficient relocation, and kill aggregate output. So empirically, we actually go to the census data and test these mechanisms, where we go to two plan firms that are constrained. I mean, there's some usual proxies of capital and size and so on. And what we see is that firms that are constrained after a firm-level technology shock, we do see these rotating patterns. So there is some evidence for this. I want to spend my last minute on basically the overall empirical picture, because this is the model of a two-plan firm. Of course, the majority of firms in the US economy operate many more plans, at least in economically relevant terms, than just two. But this is basically just illustrating the mechanism. But there's much more scope for the mechanism, because if you divide the overall variance of output per worker, the output per capital, so the marginal revenue products, into between firm component and to a within firm component, you can understand a little bit how much of the overall dispersion of the economy is taking place within the firm. And here we only look at very homogeneous firms that produce the same thing to avoid certain like simple diversification arguments. And we look at basically marginal revenue products of capital and investment rates. So what you see is that, interestingly, 62.75% of the overall observed dispersion across plans occurs within firms. Only the remaining 37.5% occur between firms. So the between firm dispersion, this is what we see in Compustat data. This is what we see among the big players, but the majority is actually going on within. So that means our mechanism has a lot of scope to act here. The same is true for investment dispersion. It's even there a little bit more, a little bit stronger. There's also some interesting facts about the skewness, which is maybe interesting to understand different types of friction, but I'm not going to talk about that now. One last thing. So this has important implications for just beyond the macrofinance literature, because looking at dispersion has been very popular to study distortions in developing economies. So Shi and Kleiner wrote this paper where they said, well, India is much more distorted than the US. And as a consequence, just closing that distortions to US level would close like something like 50 to 60% of the aggregate TFP back. So huge gains. Here we say, wait a minute, you don't have to give, not only have to give India the distortions of the US, which are lower, you also have to give India internal capital markets, because in India and developing economies, all the firms are basically single unit, except for very, very few exceptions. So that means there's more scope then for this beneficial good dispersion that they sweep just very normally into the bad part. But so that means the gains from eliminating distortions and giving internal capital markets are actually bigger than previously thought. We estimate something in the magnitude of 47%. So that's important. And yeah, so that's basically it. To conclude, I want to mention dispersion doesn't equal misallocation. With non-convexities, you can have a non-monotone relationship between frictions and the dispersion MRPK and investment rate. And we show that a calibrated model can actually explain a lot of that. Empirically, there's lots of scope for that mechanism, and it matters not only in macro, but also development economics.